Public Storage 4.0. That was the big announcement coming out of the PS Q4 2025 earnings call. Today, I'm going to share with you the most important things you need to know from this call, what it means for you and the industry. Welcome to the Self-Storage Report. I'm Chris Burr with Abernathy Holdings. Before we jump into the PS Q4 2025 earnings call, I do want to start with the most recent Yardi Matrix self-storage national report. A couple of things I think that are really, really important to note from this report. Number one, we talked about it recently here on the show. Self-storage demand is cratering right now. And if you view real estate the way Sam Zell did, one of the greatest real estate investors ever, he always talked about the day he walked into his intro to econ class at University of Michigan, said, look, let's keep it simple. On the whiteboard, supply and demand. If you want to keep things simple, because my opinion, simple good, complex bad, that is the self-storage business, supply and demand. It's really most businesses, but let's keep self-storage really simple today. And this is where the Yardi Matrix report started. As you can see here, they basically are talking about demand and how it's cratering because the Census Bureau population talks about how it's actually gone down. One of the big things you can see here, 54% drop in immigration. We talked about that recently on the show as well. State to state migration cooled dramatically, especially when we look at a state like Florida. You had a 93% drop in net migration in Florida. Thus why you're seeing the housing situation in Florida starting to turn and actually go down, where Florida homes are becoming more and more affordable. Unless, of course, you're going to go and live on the island with Zuck and those guys. I mean, Zuck just bought a place for, what was it, almost $200 million. So that obviously is an anomaly. But for the most part, you're seeing that migration to Florida is diminishing, maybe except for like that West Palm Beach, Miami area. The other piece that I want to talk about, because both public storage and extra space, this was brought up on both earnings call, and that was this report from Yardi Matrix started to talk about how they believe supply is beginning to shift, meaning that they are changing their supply in an upward fashion for the upcoming year. So they're saying, hey, therefore in 2026, forecasts have been increased by 6%, 2027 completions by 4.8%. And they're forecasting for later years, 28 through 30, to increase by approximately 10 to 15%. Again, if we're going to keep it simple, supply and demand, this increase in supply, not good for the industry. Clearly a headwind when you talk about lower demand and increased supply. What's interesting, though, when you think about the biggest REITs out there in the space, public storage and extra space, dispute might be a little bit too strong of a word to use here, but I'm going to use it. Basically disputed what Yardi Matrix is suggesting. So I'm going to play a clip for you here. This is Joe Russell being actually asked about this Yardi Matrix report. Here is what the now former, or soon to be former, as of April 1st, 2026, CEO of Public Storage had to say.
Yeah, Juan, I think we've been more right than wrong on the trajectory literally over the last 4 or 5 years, debating, some of the external tracking data sets out there. I think more often than not, they seem to overemphasize or overplay potential momentum coming into markets. We don't really see a trend or a change in the trajectory that's been going on now for the last 4 or 5 years, which is year by year decelerated deliveries. So, hard to justify what kind of data they're looking at to say there's a reacceleration. By all accounts, the development business continues to be quite complicated, quite commanding approval levels, costs, underwriting issues. There certainly are a handful of markets that may see supply as they have over the last year or two, but we're not seeing any reacceleration. And as you know, we have a very strong team out in the markets nationally. We're being very judicious on we're putting.
So as you can hear there, they're saying, like, we're not seeing a big shift where there's going to be an increase in supply. So that's the perspective from Joe Russell. Joe Margolis, the CEO of Extra Space, said basically the same thing in his earnings calls as well. I will add one caveat. When I was at the New York SSA, the CEO from Andover does a great job. They've got a great portfolio. He suggested that, look, if the dynamics in the industry were to change, meaning you had lower rates from an interest rate perspective, so your money was cheaper, your capital was cheaper, and or you start to see rental rates go up, so things were underwriting more effectively. He says, look, there's probably a lot of projects on the sidelines that no one's really talking about that could very easily be brought back into play, put on the playing field if the dynamics in the industry were to change. Based on the lower demand we're seeing, that's probably not going to happen in the real near future. Although from an anecdotal standpoint, again, I will say that our asset in Laveen, Arizona, performing very, very well in lease up. It's early for us, and yet we've seen demand actually pretty strong within that Laveen, Arizona market up to this place. Also want to play this clip for you. If you're thinking about development, look, one of the big purposes of this show is to talk about responsible development. There was a time when rates were really up and everything was going crazy in COVID, and people were like, hey, there's a piece of dirt. I'll just throw some steel on it, put some storage in there, and I'm going to make money. And now people are like, wait a second, I actually can get my equity wiped out in self-storage. I need to be a much more responsible developer. And so Public Storage was asked about development because their development pipeline, they typically do really, really well in development. I mean, you're talking about 12 handle yield on cost in some of their development projects when you dive into their financials. So, I mean, obviously great returns for them and their shareholders. But here's their most recent take as far as the development aspect of their business.
Yeah, sure. So the development business is one that we're passionate about internally because of the ability for us to pick that submarket, pick the land site, design the building, create the unit mix, and then ultimately place it into our operating platform where we can earn more cash flow. So it's one that we have a national team out looking for sites. It's also one that's been navigating through a challenging development environment, one with rising costs and obviously rents coming down in some of the markets with strong population growth. And so as we look at this year, we're anticipating a little less deliveries this year than last year, but we're focused on growing that business over time to take advantage of a growing storage demand environment in many of the submarkets around the country. And we view it as a very strong risk-adjusted capital return. And so as we think of...
There you go. If you're getting a 12 handle yield on cost, of course, a very risk-adjusted return for your capital there. A couple of things to note from this call is that one, they did mention, because a big conversation was the part of acquisitions and that they're going to be leaning into tech, which I'll talk more about here in a moment, but they actually underwrote $7 billion in assets last year and only acted on $1 billion. So they were saying like there's still this sort of tension between the bid and the ask. We'll see if that dynamic changes heading into 26 and 27. As we've said many times here on the self-storage report, my thesis is that the end of 2026, mid to end 2026 is when we're going to see a top on land prices. It's pretty clear that we're actually headed potentially towards a more long-term, now hot war. And if you have ever read The Fourth Turning, you're very clear on what that means from a dynamics perspective. So those are a couple of variables you just want to be thinking about as you're laying out a more long-term thesis in your investment strategy. The big thing too, again, from Public Storage to Extra Space, is that there's this sort of bifurcation, if you will. That's a shout out to my friend Thaddeus. Bifurcation, if you will, and from the standpoint that Public Storage really leaning into tech and AI, Extra Space strongly believing that, hey, we want to have warm bodies in our stores. We think that gives us an edge and actually can help increase our NOI for our assets. We'll see how it plays out long term. Only time will tell. There's obviously a big conversation as of late in regards to one of the things we've often said here as well in the self-storage report is the last place that you want to be as an asset class is on the lips of legislators. So there's been a lot of conversation with SB 709, Extra Space recently being sued by the city of New York, not a constituent, but the city of New York. So Public Storage was asked about that on the call as well.
There was one of your peers named in a lawsuit with New York earlier this week. Is stuff like this maybe the canary in the coal mine as it relates to sort of the pricing practices in the industry? I know there have been pushes, whether it's at SSA or the trade level around greater disclosures, but like, is there a worry that, greater, I guess, regulatory oversight from these municipalities could preclude what has been this ECRI pricing strategy regime we've been in, call it over the past couple of years?
Sure, Griff. So I think there's a couple components to that. One, obviously, we saw some of the New York activity, and we continue to work with the National Self-Storage Association and the state self-storage associations around working with regulators and legislators, and frankly, ensuring that they understand the benefits of our business, how affordable our business is, how affordable some of our new customer promotional rates are, some of those things and earlier in the conversation we spoke about how affordable it is versus other space alternatives. So being able to communicate that and educate folks. And then obviously part of PS 4.0 is a customer focus and improving the customer experience. And that goes everything from pricing all the way through.
So that's their kind of initial reaction to some of the things that are happening from more of a legislative, legal perspective in this industry. Something you want to keep your eye on. I think another good thing that they talked about on the call was they brought up their third-party management piece of the business. It's always kind of been in the background for Public Storage. I know because that's one of the partners we work with is Public Storage, is that they're starting to make some investments into the third-party management arm. They want to begin to expand that and make that more of a profit center for their business. So we'll keep our eye on that for you as well. As always, just would love to know your point of view, your perspective on what you're seeing in the industry, what you took out of this conversation here today. And as always, thank you so much for watching. Please share this with your colleagues. We'll see you back here again soon. Again, I'm Chris Berg with Abernathy Holdings. This is the Self Storage Report.